All right. This is an awesome panel. A lot of friends on this panel. We're going to talk a lot about how to navigate crypto as a venture fund. Maybe to kick it off, if you could have maybe 1-minute intro from all of you, talk about who you are, what fund you represent, how long have you been investing in crypto, personally or as a fund?
Yeah, I can start. I'm Dan. I'm a partner at Sequoia Capital. Sequoia is a VC firm that has been around for the last 50 years. We invest in startups at all stages, from seed to venture to growth. We have $11 billion across the existing funds to invest in both Web2 and Web3 companies. And earlier this year, we launched a liquid token fund specifically for crypto. This is a $500 million fund. Some of our recent marquee investments have been FTX, Fireblocks, and Layer Zero. Personally, I got into crypto in 2014, joined another VC firm, A16Z, and have been in crypto ever since.
Hi, my name is Lasse. I'm a founding partner of 1KX. We're early stage token network fund. We were, as far as I know, the first fund to say we actually only invest in tokens. So we don't touch anything like exchanges or wallets or any of the normal sort of business models that are put on top of blockchain. And we help founders bootstrap token networks.
Paul?
Hey everyone, I'm Paul Veradittakit. I'm a partner at Pantera Capital. Pantera Capital has been investing into cryptocurrencies and blockchain since 2013. I think we were probably the first institutional fund to be investing into Bitcoin when it was around $60. Since then, I joined in 2014. I've been spearheading our early stage investments. So we manage about $5 billion. We invest both on the equity side of things and also the token side of things. I sit on the board of Alchemy and a few other companies. Blockfolio, we sold over to FTX. But really excited about Southeast Asia. I'm Thai, so try to find as many amazing entrepreneurs here as possible. So in the region, we led the Series A of Amber. We also did BitDAO. I know you guys are also involved with BitDAO and Sin Futures and a few other companies. So really excited about the region.
Cool. I'm Haseeb Qureshi. I am the inventor of Litecoin. I'm a managing partner at Dragonfly Capital. We're a global crypto venture fund. We invest across the world, both in Asia and in the US. We've been around since 2018, and we've made a bunch of investments into crypto, just like these guys.
Awesome. So we have about 45 minutes today. What we'll do is we'll maybe half an hour of formal questions. We'll start really broad, and we'll get narrower over time, and harder questions over time. And then maybe at the end, we'll have 10 minutes of Q&A from the audience, so please prepare your questions in advance. So let's begin. Let's start with a broad question, right? So I began investing in crypto in 2016 personally and 2017 formally. And there's a lot of myth about what investing in crypto really means. What, in your opinion, do most people get wrong about investing in crypto? What do you think is a myth that actually turns out to be false? Maybe starting with any one of you guys. Yeah.
I think the first one is the differentiation between trading and investing. I think you have 24/7 liquidity, so it's extremely tempting to start trading. And in our mind, I still have to meet someone who actually trades successfully in crypto, unless you're doing sort of arbitrage or these kind of things. But if you think you're going to be able to trade a Fed decision or anything like this, we see with Celsius, it's pretty difficult. So I think the important thing when investing really in crypto is that you have a 3-year plus time horizon, and you really invest through multiple cycles.
Yeah, I want to second that. At Sequoia, we take the long-term view on company building. We think that crypto is very early. A lot of interest in crypto is short-termism, and this is exacerbated by the liquidity of tokens. But we really like the founders and the funds that are in it for the long run. We think that crypto, again, is very, very early. It's kind of similar to the beginning of the internet when, in 1987, the internet only had 1 million users. And then it took a decade after that before Amazon and Google, and then another decade after that before Twitter and Facebook. So, just take the long-term view.
So, the four of us on this panel are crypto VCs. Most VCs that look at crypto are not dedicated to the space the way that we are. And when they look at the space, the one thing I notice from most regular VCs is that they think crypto is all about timing the market. They think that, okay, when prices are low and that like the exact time of innovation is happening, that's when you come in. And right now, after there's been a lot of damage and sentiment is super low, most of those guys are nowhere to be seen. And so you'll notice, all of us are looking at deals right now, and we don't see regular VCs looking at these deals anymore. They used to. Like just 6 months ago, they were all piling into the stuff, but they're not looking at it now. And they will look at it again when the market comes back, when macro looks better, they'll all come rushing back in. And so the number one thing that I have come to appreciate about investing into crypto is it's about being patient. Like crypto is fundamentally about building new things. And when you're building new things in a totally open space, there's going to be booms and busts. There's going to be things people get excited about that end up not panning out. And that results in this crazy volatility that is investing into crypto. As a crypto VC, you have to learn that, like, hey, sometimes we're going to get it wrong. Sometimes we're going to have mess-ups. But overall, the direction of crypto has always been toward more innovation, getting more things right, and creating more value. And so I'd say that's probably the biggest difference between the folks who you're seeing on stage right now and the people who were investing in crypto 6 months ago but aren't investing in crypto today.
Yeah, that's a really good point. I mean, I would probably expand on that and say, like, this is a great time to be really diligent about, rounds are getting a little bit longer to being, sort of like, executed and done. And both on the investor side, but also on the entrepreneur side, you got to really have a chance to figure out which investors are a good fit for you. And as Haseeb has mentioned, I mean, there's a lot of investors that come in during the bull market and go away during a bear market, and that could be really tough for entrepreneurs, especially when you're trying to build a business and you don't have investors that are aligned in terms of how to grow the company. You may have to take shortcuts or make money sooner rather than later. You may put ads on a social network that isn't ready for a social network. I mean, things like that. So, really take a look at your investors and, see if they are aligned with, being long-term and how you want to build your business. I think the other thing that is, sort of not really talked about is, what can investors do for you? You see a lot on the forums out there on, hey, we want to, you guys are trying to get into Lido, we were trying to get into SushiSwap, and a lot of the community is like, yeah, but these VCs, like, as you mentioned, like, there are vesting schedules, there are people that aren't going to sort of dump along the way. There are people that actually want to build businesses. And I know a lot of us are focusing on how we can build our firms and our platforms to really service the entrepreneurs, whether they're a little bit more general and providing a lot of access to vendors, but things around recruiting, things around building communities, global communities. I know you guys do a lot of cross-border stuff. You guys all do a lot of traveling and have different arms at Lightspeed and Sequoia. And I think the other thing that at least Pantera has really been leaning on is really being vocal about governance. I know there's been a lot of talk about whether firms should be vocal about governance, especially as these are sort of open boards, and there's a lot of things that kind of go into that structurally. But I think for Pantera, we know that we have a role in the community. We have a role as early investors and significant investors. So that's one of the things that we've been really kind of pushing forward, is really trying to direct people in ways that we feel is right for the protocol.
Yeah. Well, a lot of interesting themes around trading mentality versus building mentality, long-term versus short-term mentality, force-fitting a business model that may not be ready for crypto today, but because it works elsewhere, maybe it'll work here. That kind of ideology. I feel like we're going to touch upon a lot of these topics as we go forward, but maybe just still staying broad. I'm curious to sort of hear, and there probably are new investors, people are coming into crypto now, and it's the perfect time to get into crypto in a bear cycle because it always go up from here. But when I began investing in crypto, one of the common mistakes that I made personally was that there is a value attached to founder confidence. And VCs attach a lot of weightage to a founder's confidence, the inbound fundamental confidence. And in crypto, I realized, after making a bunch of mistakes, that confidence comes from two things. One is having built something of value, having understood a market really deeply, having a very sharp point of view in your business, or money in the bank. And in crypto, a lot of people have money in the bank, but haven't built something of value yet, right? And that thing was, it took a while to really understand the separation of the two founders. So I'm curious, as you began investing in crypto, what were the common mistakes you made? What do you think are the gotchas that people, should be aware of as they begin their first investment into crypto?
I think if you, in the bull market, you did a large round and you, as an entrepreneur, and you optimized for valuation, you should be really, really scared right now.
Yeah.
Because money really changes people. And if you have too much money in the bank account, it really is a problem. And there is data that really shows us that these projects that over-raised, they just deliver less and they become less successful in the long run. Don't move.
Dan, can you grab my water?
Yeah.
Oh.
So really, there's data that shows that above a certain amount raised, you will perform worse. So I think that's really, one of the big challenges, especially in crypto, because you also might have liquidity much earlier on your tokens, right? So if you're a normal Web 2 entrepreneur, really it takes you 5 to 10 years to IPO, and this is where you get meaningful sort of liquidity on the fruit of your labor. Whereas we've seen this a lot of times, you have 2 years vesting schedules, and you have tokens instead of an IPO at the end. Here you have liquidity like an IPO, maybe at an A stage round. And which means that probably by the time it's sort of a B stage, it doesn't mean that the business or the project has been successful yet, but the founders, if they only had a 2-year vesting schedule, they pretty much can sort of check out like an entrepreneur after 10-year IPO. So I think that's, raise a little bit more money than you really need, but not much more. I think that's one of the most important things.
Yeah. Please,
Yeah, I think that's exactly right. Another point that I wanted to bring up was something that you alluded to, Hemant, which is not mixing fake traction with real traction. At the end of the day, as a founder, as an entrepreneur, you are looking to solve a market problem, and it is very easy to trick yourself into thinking that you have traction when you don't actually have traction because the price is going up, the entire market is going up. But then as soon as there is a market correction, all of the interest kind of goes away. As a founder, what you really need to do is to find product market fit, find real adoption. And that's something that a lot of crypto founders are coming to terms with right now. I think another thing from the investor side is to not over-rotate on market conditions. I think all of us are human. We have a tendency to do this. So when the market is going up and to the right, everything is looked at with rose-colored glasses. When the market is starting to go down, when we're in a bear market, we start to lose the kind of ideas of why we got excited about crypto in the first place. And at Sequoia, we've been through several market cycles now, not just crypto market cycles, but global macro market cycles. And one of the main takeaways through all of that is to just be very consistent when you're evaluating companies.
The one thing I would say is that when you're in a bull market as an investor, generally speaking, a simple strategy that usually works is see what's working and throw money at it, right? So it's like, okay, OpenSea's growing, throw money at OpenSea. Solana's growing, throw money at Solana. And in a bear market, that stops working, because in a bear market, nothing's growing. Everything's either treading water or it's going down. And so I think a lot of entrepreneurs also don't really key into this, because in a bull market, it's very easy to raise money for a very incremental idea. So, here's a slightly different NFT marketplace, or here is a something metaverse. And great, you can raise money, you can do a seed round, you can get some cool investors on your cap table. In a bear market, those things just become much, much harder to raise capital for. And really what that's pushing you towards, or what it should be pushing you towards, is to actually be more ambitious and to try to solve a bigger problem. And in a bear market is exactly the time when you want to try to take a swing at the biggest possible problem that you can imagine. If you think about the really amazing successes of the last cycle, they were Solana, OpenSea, Uniswap. All of them were founded in the bear market, and all of them were trying to solve a really massive problem that at that time people didn't really fully believe that there was even a there. Right? Like at the time that OpenSea launched, it was after CryptoKitties had already collapsed. Nobody cared about NFTs back then. When Uniswap first launched, the term DeFi hadn't even been coined yet. And DeFi traded less than $1 million a day. Like the ambition behind these projects was that we are going to totally reinvent this space. And they got it right. Not everybody gets it right. But that, to me, is what I want to see more entrepreneurs doing right now. And I think also investors respond to that. I think a lot of entrepreneurs believe in a bear market that investors want to see them doing very safe things. And it's actually the opposite. Investors want to see entrepreneurs taking more risks and going after something bigger than they otherwise might imagine.
Yeah, really well said.
Yeah.
Paul.
I would say it really depends. I like what you're saying, but I would say it really depends on, I guess, the background of the entrepreneurs and sort of the space that they're in. Because I was going to say that, like, in a bear market, it also is pretty good to just solve one thing and solve it really well and be focused, especially if you don't have a lot of runway. You know what I mean? If you're able to, if you got a great background, you're able to raise from, some of the bigger funds out there, $30, $40 million rounds, you kind of go after the big ideas. But if you're only able to raise a seed round, I think it makes sense to, I'll give you an example. Like maybe it's like a chain analysis. You want to solve a problem around forensics. Maybe it's like nodes, maybe it's staking. And then later on, you got to go into selling data, you go into other sort of services. But I think you have to sort of, figure out a way that makes sense to sort of get to making money, get to profitability in a bear market. But if you have the opportunity to swing big, I mean, man, just
well, here's what I'd say. I'd push back on that because we talked earlier about how there's been in the last market oversupply of capital, right? Lots and lots of money invested into these projects. If you look at again, so going back to those three examples, right? OpenSea, they raised a tiny seed round back in 2019. Basically built the whole thing before they got any of the money, right? They got all their money basically last year, and the product is not that different than what it was last year. Uniswap literally got a grant. That's what the original Uniswap was built on top of. And Solana, you remember, you were there with me when Solana was going out trying to raise their round, and like nobody was biting back that time. And so I think what the reality is, a lot of crypto companies can raise a lot of money, especially in a bull market. People get really excited, but it doesn't take that much capital to build things in crypto, right? That's why crypto is so beautiful. Is that it doesn't require that much because it's all software.
Yeah.
So I think sorry, go ahead.
At the end of the day, I mean, if you build a great product and you can do so, and especially around DeFi, you can really get out to market, and then from there, like, it'll make it a lot easier. Getting traction is just, super huge. But outside of that, I mean, I think the other tips that I would say is, go-to-market is really important in this space. I think a lot of people say just build a product, build a technology, it'll come. I would advise founders to both start early in building your community and do a lot of things around content marketing and whatnot that don't cost a lot of money. And then also think about liquidity too, because at the end of the day, you want tokens to be able to get to a larger community. So some people think about like getting on exchanges or getting on DEXs or so IO is like a bit too late. I'd say start thinking about that process really early on. And then on the investor side of things, what I would say is like get aligned with your entrepreneurs. If you're going to create a structure around a deal, it's kind of nice to know that the entrepreneur is going to build a suite of games that has tokens for each one of these games, and you want to make sure that you're structured in a way to get alignment all around. So I think just making sure you see the vision of where these companies are going to go and make sure that you have the value accrual around sort of how you're structuring these rounds to be appropriate.
Yeah, makes a lot of sense. I mean, building and selling, it seems to be that's the common theme across all VCs and what we look for in founders. Coming to the point about this being a global market and anybody can build from anywhere, anybody can get investments from anywhere. Maybe a question for you, Haseeb. I mean, you are one of the funds that I thought was very unique in the sense that you are global from day one, right? And people think of venture capital as a local market. You have local access, you understand local nuances, you build for local population and so on, and you get successfully local. What do you think, given you have been investing in founders from the West and founders from the East, and I'm calling it West and East not to ignore the other markets, but they seem to be the two big epicenters of crypto for now. What do you think founders from the West could learn from the founders that you might have seen, the founder archetypes from the East, and what do you think the East could learn from the West here?
That's a good question. I mean, I think the reality about crypto is that crypto has been global from the very beginning, and within a week of the Bitcoin white paper being published on Slashdot, it was translated into Chinese, and Bitcoin started getting traded in China. And so the interconnected global nature of crypto has always been there, but sometimes it's opaque, right? Sometimes you don't notice that when a DeFi project goes live, it has customers and users and developers who are in totally different languages, in different language communities, and different apps than the ones that the developers might be using. I think what I've noticed over time, one is that there's certainly more convergence between those two communities. They were more fractured before. I think COVID really changed a lot of things because in the era of COVID, we all had to really just live online. And crypto always kind of lived online, but it lived online even more post-COVID. And that makes it a lot easier for communities that don't live in the Anglophone market to be able to access all the conversations and materials and thinking of folks who are in the Western side. The obvious thing in Asia is that the biggest companies in the world in crypto are all Asian. Right? So like Binance is Asian, OKX is Asian, Bitmain is Asian, and it's not just that they're Asian founders, but I think also the DNA of these founders, a lot of these guys were built in the O2O era in China, where they're extremely operationally efficient. There's just kind of ruthless obsession about margins. And you don't get a lot of that in the US. Because the US, traditionally, especially in Silicon Valley, it's a place where capital is very cheap. It's a place where it's like grow, grow, grow. Don't really worry too much about the margin along the way. When you're really, really big, then you can worry about profitability. And China, especially in crypto in China grew up in an environment where there was no capital markets. There was no external funding. So you needed to be profitable immediately. And so the founders that you see in China, they tend to be, or not in China necessarily, obviously most of them are, there's a broad diaspora into places like Singapore, into Hong Kong, into Dubai, and these different places now. But the founders that cut their teeth there, they just have much, much, much more efficiency and rigor. You look at Coinbase, right? Coinbase, infamously, obviously, very Silicon Valley company, grew really, really big. Now they have thousands of people and incredibly unprofitable, which is exactly the opposite thing you'd expect by the time the company goes public. It's like, now we figure out what worked. We're going to stop doing all these crazy experiments, and we're going to be lean. Binance, OKX, these companies have been like that from day one. Yeah. So that, to me, feels like probably the biggest distinction. But on the Western side, it's just hard not to notice that most of the technological innovations have come from the West. And I think a lot of this, I don't think it's the case that people in Asia or people in the East are not smart enough or not creative enough to do it, but a lot of it is because they've been really stymied by their own governments. So, I like to remind people, like Stanford had a blockchain class in 2014. I mean, not everyone was teaching blockchain back then, but Stanford was. China got its first blockchain class in 2019 when Xi Jinping announced the Blockchain Plus initiative, and then a year and a half later, that class was canceled when China banned crypto. So in that kind of environment, it's just much harder to build the intellectual infrastructure that you need for real, intellectual research or innovation to take place. And so that's where I think the East is still playing catch up. But in the long run, I think they're still going to get there because all this stuff lives online.
Yeah, love that answer. This is great. Maybe staying on the global theme for now. Maybe a question for Lasse for you. You are token only, just your tokens, and that's the first thing that comes to mind when you think of. You can launch from anywhere, you can get customers from anywhere, you can build a brand anywhere. But tokenization at the early days almost feels like, when you have a token event, almost feels like you've gone IPO. And in the traditional world, you build a product, you build a brand, you build a community, you have 10, 7, 10, no, even longer than that. You have 10 years of bake period, and then you go to public markets. In crypto, it seems like you can go public pretty much day zero, sometimes even before you have launched anything. And that adds additional pressure. It adds pressure from your customers, pressure from your investors, your employees, your token prices go up and down. What do you think founders need to do now, especially going into the bear market? What do you think are the common mistakes people make that we should be aware of? And what is your strategy to sort of really put people on the path of success as they tokenize?
Yeah, so I think the first thing you have to understand that you have startups were very, very hard. Crypto projects are even harder because you have all the challenges of an early stage software startup, and you're a publicly traded company, probably at your seed or A stage, right? And being a publicly traded company with a very broad investor base has a lot of problems. A lot of retail investors are very, very short term. Most of them don't understand how difficult it is to build software. They're impatient, right? So they sort of maybe participate or get your token and constantly keep nagging sort of, can you do something? When is something going to happen? So I think, it's at least twice as hard, I think, to do crypto projects. But if you do, for the infrastructure that we invest into, decentralization really is most of the product. The part that this is not controlled by 3 guys in a boardroom that can do whatever they want to people who use the technology, but really that it is a network that's controlled by the users and the suppliers. That is part of the product, and this is why it actually is valuable. And so you need that process usually very early on. At the very least, you need to have thought about it, mapped out your stakeholders, and probably run agent-based simulations, etc., on things on token distributions and how those could pan out. And so I think that's just really what we see. It will be much harder than doing a SaaS business, and it will be even much harder than doing another exchange that maybe has lower fees that trades crypto. These token networks, at least the way we invest in them, the decentralization is one of the main features of the product, and it's incredibly complex because the founder type is very different. If you have a Web2 company, you basically need 3 alpha guys that are just sort of benevolent dictators and whip everyone forward, and they say what's happening and whatnot. In Web3, it's very different. You need someone like a Vitalik. You basically need someone who inspires a lot of, ideally, developers to adopt, to build, to innovate, etc. on your network, but you're not directly controlling people anymore. So it's very different to the typical VC-funded Web2 entrepreneur. A Web3 entrepreneur is more of an inspirational figure, I would say, right? At the early days, they can lead the direction, and you want progressive decentralization, right? You don't want, MakerDAO was basically decentralized from day one, and you have 20,000 people deciding on product features. That's probably also the wrong way. What we're sort of learning is that you have this concept of progressive decentralization, where, yes, in the early days, it's a team that ships most of the code very centrally, but they do so in a completely open format. They do take the right amount of community input. That's also in the early days, it does matter. You can't just do anything your community wants you to do because, again, they rarely understand software, the complexity of it, etc.
And is there a founder that you would advise against tokenization at all?
Sorry?
Is there a company that you would say you should not tokenize, you should not have a token launch?
Yeah, I think generally you have to focus on product market fit. And then keep the token and the distribution of your network in mind from day one as well. But the most important thing is still product market fit. But it comes back to the challenge. In the bull market, it can look like you have product market fit by just issuing a token. So I think, and this is actually where the SEC, I think, has been helpful, is that they've pushed the space to, you have a live network, you have an actual function of the token, then it's okay to sort of publicly trade it. Whereas, in the early days, someone basically sold a token that was immediately tradable and said, with this money, I'm going to build something that in 2 years maybe has functionality, and then you can use a token. Yeah. And I'm very glad that we went away from that, largely thanks to the SEC. So the main thing is still build something that people want. That's the most important thing. But you do have to understand and really project and simulate already that how this is really going to decentralize.
Yeah, very helpful. Question for Dan. We have actually a very similar background. Right? We've been founders before. You are far more successful as a founder than I ever was. We have done operator roles before. We were at A16Z before. I'm curious, as a fund, Lightspeed and Sequoia, they compete, we collaborate quite a lot. We've been investing in crypto for a long time. I'm curious, how has your approach to investing changed or not changed as you look at crypto?
Yeah, first off, you're far too humble and far too kind. I do want to say that across my experience at A16Z and also as a founder, a core tenet at the funds was you want to put founders first. And when you actually live the founder lifestyle and you experience firsthand the ups and the downs, that really cements that in your mind, and that transfers over when you move to the other side of the table and become an investor. And there are so many companies, countless companies, that were knocking at death's door, my company included, where it wasn't except for the strength of the founder, that they were able to pull through the other ends and eventually, succeed. And one of the things that we really look for at Sequoia is we look for outlier founders, founders that we believe that we can partner with, that we want to grow with in the long term. So I would say, number one, just be founder-centric. I think a secondary, maybe slightly smaller points is crypto. We've been through several cycles now, got in 2014 at A16Z and then started my own company in 2017. And a lot of ideas are tried many times over and over. many times just reskin, slightly different UX. But one of the things that we end up looking for is, net new, unique ideas, novel insights, and founders who have them.
Yeah, I was on Dan's board when he was a founder and CEO, so I can speak to how smart and resilient he is, and yeah, those are the type of founders that you want right there.
I'm blushing.
Wow. Paul, a question for you. You guys are the OGs. I think we've been interacting and working together since 2013 as Lightspeed and Pantera, so thank you for the partnership, the friendship over the last decade or so. You've been deep in the middle of two bear cycles, really like the middle of it, right? It happened in front of your eyes. And I'm curious, what did the water cooler conversations look like when you were going through the first cycle, which was right after I think you began deploying into crypto, right, in 2014, and then in 2017. And how does this cycle look different or same from the ones you've seen before?
Yeah, no, first and foremost, this is the best time to be building in a bear market as an entrepreneur, but also as an investor. And so, entrepreneurs, we talked about this right before us at the stage, but entrepreneurs do remember investors that grind through the bear market and what they do. I think for us, 2014 was very early in our fund life cycle. It took us 3 years to raise $25 million for our first fund. And the entrepreneurship landscape was really just investing into a bunch of seed stage companies and likely not even having a choice whether to lead or not, because no one else was willing to go up to the plate and actually put some terms in there, even though we're a small seed fund. And so we kind of went in there and went with the thesis of really investing into local infrastructure, so investing into brokerages and exchanges all around the world. So it's been really helpful to kind of get that global perspective, not only in Asia, but also Latin America, Africa, et cetera. But it was tough. Institutional investors weren't interested at the time. It was mostly high net worth individuals. And then, fast forward to 2017, 2018, right before the 18 bear market, really, it's exactly what happened more recently, where you started to see a lot of capital coming into the space, and then a lot of entrepreneurs coming into the space. From there, really started to see some of the pain points that really needed to be solved, especially around scalability. So, post, that last market, I remember we were investing into a lot of layer ones, and they've done very well. We started to see, during the last bull market, some layer ones actually start reaching some of their potential, starting to reach some scalability. And then, this last bull market, we really started to see a lot more institutional capital come in. I think all of our funds can sort of say we have a bit of institutional capital, probably different pockets here. Well, you guys are different. But
They don't count.
You guys are just educating your institutional capital. We're starting to see institutional capital come in, a bunch of the endowments and pension funds and other corporations all around the world, and then a lot of new seed funds created. What does that mean? That means that we have capital now to actually fund entrepreneurs. Entrepreneurs can come in and feel comfortable that they can have capital, but also the right partners involved. And so, what's also sort of unique is that the capital isn't going into just equity, which you would imagine. Our last venture fund was a fund that has equity and tokens. So, as we were talking to institutional capital, we're saying, hey, we'll give you equity, and no, actually, we want tokens too. We're starting to see what's going on with decentralized finance. We're starting to see, how this could be applicable to what I'm doing with our financial and asset management firm. And so that was a big shift for us to sort of see that there was an interest both in equity and tokens. And now you see entrepreneurs that are coming in and building not only on the equity side of things during the bear market, but also on the token side of things. So that's been a huge shift. If it wasn't for what's going on in the global macro environment, I wouldn't think that we'd have such a big drop on the liquid side of things. Especially with all this capital that came in, we sort of imagined the next bear market to be not a bear market, but just like mini bear markets along the way. But obviously we have something else that's been kind of coming into this. But I also think what's going to be different this time around is, during the previous bear markets, it's mostly been a huge shift towards innovation in the US. I really do feel that now that we're starting to move over to a little bit more of the application layer side of things, there's an opportunity in Southeast Asia for gaming, for NFTs. And so, you know, it may not seem like it, but if you guys are building in this space and you guys are looking long term, it's a great opportunity to stand out. Stand out with a lot of the institutional capital like the Lightspeed Indias that are willing to actually look for strong entrepreneurs that are building use cases that, you know, are going to be tangible and really matter. So I think it's a great opportunity right now for Asia to really differ from in the past and really actually just be builders during this market.
Yeah. Yeah. I mean, when we did our work when we sort of started investing in India and Southeast Asia, one of the things that really surprised me was in 2021, 2020, we had about 200 blockchain developer job postings on LinkedIn in India. And a year later, we had 10,000. And compare that to US, if you do the same search, not that it's all apples to apples, it's 30,000. So the growth has been pretty massive. And then when so many smart people come together, I feel like it's really dumb to bet against it, usually. Usually it's been the dumb bet. So now looking forward from here, right? Let's talk about maybe questions starting with you, Haseeb. We've gone through the ICO wave, the DeFi wave, the NFT wave. What green shoots are you seeing and observing now? What is exciting for the next 5-10 years of build phase that we are entering now? Haseeb?
Yeah, no, it's a great question. I was saying earlier how, you know, a bear market is a time when you want to work on big problems. And one of the projects we backed recently, actually, I'm really excited about. It's I'm sure most people have heard of Aptos. So Aptos is this blockchain that is basically spun out of Diem, or Libra, as it's formerly called, and they end up building their own Layer 1 blockchain. And we end up making a big strategic investment into them. And a lot of the impetus behind why I'm so excited about it is that, you know, if you look at the last cycle, there's been so much investment into scalability. But it's very, very clear that even after going through this massive growth spurt and all these new blockchains that have come out and layer 2s and all this stuff, we still don't have enough scalability to handle all of the demand that there is for block space. And in order to really get there, we have to be much more innovative from the ground up. And one of the things that's so impressive about, you know, the Libra ecosystem is that, you know, Facebook basically put 4 years of R&D into that tech stack. And it is now quite possibly one of the most, you know, pound for pound, like robust software stacks that we have that is in blockchain land. And the Move ecosystem is completely re-architected from the ground up. It's tough to start a new ecosystem, right? Especially now when, you know, it's a bear market, things are a little bit quieter. But the team behind Aptos has just been really impressive in the way they've managed to build community, build excitement, build momentum. So it's you know, something like Aptos is exactly what I want to see people working on right now, is trying to go and solve the biggest problems in crypto. There's always a chance it fails. I mean, crypto is all about taking big risks and trying to solve massive problems. And so that's the kind of thing that I'm excited about right now.
Got it.
Yeah, unfortunately, the last bull market, it came a little bit too early because all that investment into scalability in L2s, they weren't quite ready yet, right? You just had the first one, sort of Optimism and Arbitrum. They just recently came live. So most of the bull market activity really still happened on Ethereum L1, which is insanity, right? And you've had, you know, $85 to transfer a token. And you've had Solana, but Solana at that point was a 0.8, right? It wasn't production software, so it had issues. So unfortunately, that, you know, all that sort of 2018, 2019 investment into scalability isn't actually quite there yet. We have ZK Sync, which is a portfolio project that will launch in like 30, 40 days with L2s. So you're now actually, only now we're starting to have infrastructure to do, you know, more end consumer applications. So again, it's a fantastic time for, you know, consumer entrepreneurs to come in and build applications, start building applications on L2s and then possibly L3s, because you will have, I would say within a year, you actually have the infrastructure to do, for example, first time, actually payments on blockchain. Until now, whoever has been promising you that blockchains are good for payments, they have not been. They will start maybe in a year, you start getting to the point where normal retail payments on blockchain will start making sense. You will then start getting to a point where games on blockchain actually start making sense. So that's sort of what we see, that we're going to see an explosion of consumer applications in about a year or two, because you can actually only have the underlying scalable infrastructure maybe starting in 6 months to 1 year.
Yeah.
I do want to emphasize the payments space, because that is something that has been underemphasized probably since 2016, when Web3 became the primary narrative of crypto. before that, when it was primarily Bitcoin, payments was the killer app. And what we're seeing now is a combination of three things. One, massively more crypto adoption than we had 8 years ago. Two, L2s, scalability solutions starting to come online. Three, we have the proliferation adoption of stablecoins, which was missing when Bitcoin was the primary asset that was transacted from one party to another. So that is a space that I think holds a lot of promise and may come online faster than we think. Agree with everything my fellow panelists have said, and I think a final area that is maybe a little bit understated but also very widely explored right now is identity as the missing layer between your wallet as the core primitive for you to interact with Web3. So specifically a way to connect your off-chain and on-chain identities.
Yeah. Paul, and then we'll go to a couple of audience questions after, but Paul.
Yeah, I agree with what everyone else said. I mean, I think on the scalability side, I think it is really important. I mean, I really do feel like consumers can be huge, especially outside the US, and I think NFTs are going to be, a path for that, especially in Asia. I mean, I feel like there's a lot of brand equity for individuals and also for companies, and so you can't have NFTs actually be anything more than speculative. You can't have them be utility unless you actually reduce the transaction cost to actually make that happen. But I do think, like, for us, I mean, we're interested in seeing how NFT evolve, but then also, like, we're investing into the infrastructure around NFTs too. So we invested recently into a company called Optic, which is like sort of like chain analysis for NFTs, providing technology using computer vision and AI to really kind of figure out, both for as a consumer tool, but also as an enterprise tool. They work with OpenSea right now to basically just help, instantly figure out whether an NFT is real or fake and do it at scale. So I think, whether it's on the infrastructure side or whether it's companies themselves issuing or, providing tools to, have companies access NFTs, I think that's really fascinating. And then the last thing that I'll mention, because we do have some unique insight, because we're investors in Pin2, which is Coinbase of Southeast Asia, Bitso is the Coinbase of Latin America, is, talking to all of these exchanges and brokerages in the outside the United States, there is a huge, push for the adoption of stablecoins right now. There is a push for using cryptocurrencies, whether they are stablecoins or not, as forms of remittances, and I think that's going to get even larger. So Bitso has reported that 9% of the remittances between US and Mexico is actually being done, through their platform with cryptocurrencies underneath. No one needs to know that cryptocurrency is being used for cross-border payments. We know that MoneyGram, we know that Western Union has used cryptocurrencies as one of their rails. So it's just going to get bigger and bigger, and especially as more and more consumers have cryptocurrencies natively, they're going to actually do it themselves versus actually going through some of these services where they don't know that crypto is being used.
Very interesting. So we probably have just maybe a couple of minutes, so we can maybe take one or two audience questions if there are any. And I would recommend maybe one of you just pick it up and answer that. So could we maybe get the microphone over there? Gentleman on the blue shirt, please. The one in the middle, yes. Go ahead. Yeah. Can you wait for the...
Can you speak up?
Yeah.
So I have a question regarding making decisions when you're looking for investments. What should be a more important factor to consider? Should it be the technical innovation behind a product, or should it be the adoption metrics? So, like, what would you compare crypto industry to? The tech industry like Facebook, Google, or SpaceX or Tesla, where the tech matters more than adoption?
Maybe a really quick answer if any one of you want to pick it up. Is what's more important, technical innovation as you look at founders and companies in crypto, or is it more about adoption and scale?
I mean, the answer is always all of these things, right? There's no, unfortunately, it's like asking what do you look for in a partner? Somebody who's trustworthy, somebody who's nice, somebody who's attractive. It's like, well, I kind of care about all these things. It really depends on what it is you're building as to what's going to take more weight. If you're building something that's consumer-oriented, I don't really care what the technological innovation is. I want to know if consumers like it. If you're trying to solve a deep technological problem, I might not care so much about your background as whether or not you have a stroke of insight that's actually going to solve the underlying problem. So I think it depends on the circumstances of what it is you're building.
I think we're going to get kicked out of the stage now. So I want to thank Haseeb, Paul, Lasse, Dan for your time, and thank you for the audience for hearing us. Thank you.